But joining me now is Gerard Cassidy, co-head of Global Financials Research at RBC Capital Markets. And Gerard, we turn our attention back to these bank stress tests that we just got from the Fed. So what is your takeaway on the results we just got, especially given the fact that we have, 2 full working days before the banks can start to make announcements about what it'll mean for buybacks and dividends?
Sure. Thank you, Morgan. And the results across the board were very positive. As you pointed out in your comments, all the banks passed. And what was noticeable was the pre-tax, pre-provision net revenue, known as PPNR. That was more robust this year. And the Fed pointed out the reason for that was that the industry is more profitable, driven by 2 factors: robust capital markets revenues, but also a resilient net interest margin. Also, as you pointed out, the actual decline in capital wasn't as severe this year, even though the stress scenarios were very severe. So I think overall, I think investors should be very pleased with these results, which, to your point now, the banks will review the results, and then some of them will come out as early as Monday with possible dividend increases and also share buyback programs.
The banks have had a good run here in anticipation of this. It seems J.P. Morgan and a few of the other big bank names have been hitting record highs on a near daily basis as of late. Can that continue?
I think it can, because there's a huge change going on in Washington with the bank regulators. You saw it in the commentary from this report. Michelle Bowman, as you know, is the new vice chair of safety and soundness for the Fed. And in an April release, they talked about the changes that might be coming for this stress test. There will be more openness, more transparency. That will be discussed later in the year. The big news, though, Morgan, is, of course, the Basel III endgame. She's going to need to address that, which she plans to. And she's taking a more realistic approach versus what was proposed back in 2023. So I think that's why investors are positive on the banks, why we're positive, that the deregulation outlook is quite positive. And Treasury Secretary Bessent has also pointed out that the corset around the banks due to regulations needs to be loosened up so the banks can become more involved in the economy to help the economy grow faster. And I think that's why you've seen the stocks do as well as they're doing.
So what do you buy here? What are your top picks?
I think you can look at Wells Fargo as one of the top picks because, as you probably recall, they just had their asset cap lifted. So there's going to now be opportunities for Wells to grow their balance sheet. In addition to that, they had about 13 cease and desist orders since their CEO came on board, Charlie Scharf, back in 2019. And then I think 12 of those have been lifted. 6 or 7 this year have been lifted. So that means the cost, and they have pointed out the cost of adhering to all these regulations is about $1.2 billion. So I think that cost won't certainly be going up, we don't believe, and over time probably kind of goes down. But more importantly, they get to grow that balance sheet and grow revenues. And I think capital markets and investment banking will be the focus of that company, along with their credit card program. The other name that people can look to as well is Bank of America. Bank of America is probably going to show some of the best net interest income growth this year out of all the big banks, which could take their stock higher as well. And in both cases, as well as with J.P. Morgan and Citi, there's going to be tremendous opportunities to give back excess capital. And I think you're going to see that with the money centers and the regionals, like a Fifth Third, a Regions, and an M&T are all names people can look at.